Today's market moves weren't just a simple reversal, they reflected a moment where the diplomatic hope of the last few days collided head-on with a new hawkish reality from the Federal Reserve. The U.S. markets suffered a violent sell-off today, completely erasing the gains we saw during the early week relief rally. The Dow led the decline, dropping nearly 1.7%, while the S&P 500 and Nasdaq both slid roughly 1.4%. But the real story was in the safety assets. Bond yields surged, with the 10-year Treasury reclaiming the 4.25% level. Even more concerning was the action in gold and Bitcoin, which both saw heavy selling. When you see gold drop nearly 4% alongside a falling stock market, it's a clear signal that institutions are liquidating their winners to cover losses elsewhere. Meanwhile, crude oil jumped back toward $97 as the physical supply crisis in the Middle East re-intensified. The primary shift today came directly from the Federal Reserve. While they kept rates steady, their dot plot projections sent a shockwave through the room. The Fed essentially removed their projected rate cuts for 2026, with Chairman Powell pointing directly at persistent energy-driven inflation. This effectively destroys the Fed put, the idea that the central bank would step in to save the economy if growth slowed. Investors now realize the Fed is willing to let growth buckle if it means keeping a lid on the inflationary fire started by $100 oil. On the ground, the diplomatic workaround in the Strait of Hormuz effectively failed today, following fresh strikes on tankers, shifting expectations from a temporary freeze to a structural deficit. Institutional money is moving into an emergency deleveraging phase. We saw capital flow into energy and industrials, but this wasn't a bet on growth, it was a move into inflation protection. The most alarming signal, however, was the indiscriminate selling of both consumer discretionary and staples. When investors dump luxury goods like Lululemon alongside basic household staples, it suggests they aren't just rotating sectors, they are raising cash. They are preparing for a liquidity vacuum where the Fed is no longer a friend to the markets. Underneath this volatility, a structural fragility is building in the commercial real estate market. With the Fed signaling higher for longer today, the cost to refinance the trillions in property debt due this year has just become a lot more expensive. An interesting debate in markets right now is whether we are looking at a wave of strategic defaults by major property owners as early as next quarter. I'd be interested to hear how you see this developing. Is the market underestimating the impact that these rising yields will have on regional bank stability? Let me know your perspective in the comments. The broader macro signal today is that we have entered a medium-term regime shift. The soft landing narrative has been officially abandoned. By removing those rate cuts from the horizon, the Fed has signaled that stagflation is no longer a hypothetical risk. It is the current operating environment. We are seeing a market that is now ruthlessly rewarding tangible, real economy assets and punishing financial abstractions. Looking ahead, the next 24 hours will test whether the labor market can withstand this pressure. We'll be watching the initial jobless claims very closely. If we see a spike in unemployment while the Fed is still talking hawkish, the fear of a policy mistake will move from a whisper to a roar. We're also keeping a close eye on the ECB. If they follow the Fed's lead to defend their currency against energy costs, it will only accelerate the global liquidity drain. The broader takeaway from today's market reaction is that the diplomatic relief we saw earlier this week was a trap. The Fed has removed the floor from the market, making liquidity the most valuable asset in your portfolio right now. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.